What is going on, guys? Mikkel here, and today we're talking SPACs. Specifically, some SPACs I don't like, some SPACs I do like, and some SPACs I'm sitting on and just waiting to see what happens. I'm currently a big believer that the SPAC market is going to make some amazing stocks in the near future, because SPACs really just offered retail investors an opportunity to invest in some very early stage companies. That being said, I'm sure SPACs are also very overhyped at the moment, so it's one of those sectors where you really have to pick carefully. If you enjoyed this video, make sure you like it down below, comment what you think, and subscribe to the channel. Also, if you guys enjoyed this video, make sure you check out some of the other videos on my channel, because you might find some other interesting companies you want to check out. Anyway, guys, let's jump right into it, because I think I'm going to help you guys really understand what we're seeing in the SPAC market right now and how to really find quality in the SPAC market and not get tied up in hype. So to start off, I want to get into some SPACs that I'm really not a fan of, or if I'm not a fan of, maybe I am, but at a lower price, and the first one being Lucid Motors. Lucid Motors is a company, an EV company, which is a very overhyped space in general, and that's coming from someone who has a lot of money in Tesla, but it's trading at a $32 billion market cap and only producing $174,000 in revenue. That being said, they're also losing over $1 billion a year, and overall, this company really has a long way to go before they're going to be turning profits and selling cars at any kind of scale that Tesla is. My biggest problem with this company right now is really the market cap they're trading at $32.4 billion. Honestly, the financials are just horrible, so there's no reason for me to get into it too much. But the cars actually look really cool, and they are a legitimate company. My biggest problem with them really is the valuation they're trading at. If Lucid was to come down, and I know this is going to sound pretty crazy, but if it was to come down to $5 to $4, then I would be extremely interested in possibly adding some Lucid. My biggest problem is this $32 billion valuation, because in my opinion, it could take 10 years for this company to even be worth this amount. I'm worried this stock is very overhyped, and when I get into some of the stocks later in this video, you're going to see why this valuation is so insane compared to some companies that are making way more money and have a much more scalable business. Let's not forget that Lucid is selling cars, which is not an easy market to be in. Elon Musk has came out and said multiple times that Tesla almost went out of business, and that is one of the best engineers of all time. That being said, I am overall a fan of what Lucid's doing, but this market cap kind of blows the company for me, and the big reason why I will not be touching Lucid before I see this stock drop a lot. I see a lot of investors get very impatient with stocks like Lucid and see one dip and say, oh, I have to jump in, whatever. I really think Lucid is one of those where you want to sit on your hands and keep it on your watch list for a couple years and see how they develop over the long run. If this company goes and doubles to a $64 billion valuation, I'm fine missing that, because that would be insane to me and I would be selling anyway. I would much rather see this company trading in the $1 billion valuation. It would make it an attractive investment. If you're a fan of Lucid, I'm not bashing Lucid. I think they're a really cool company. I'm just bashing the valuation the company's trading at. Let's jump into another one, and that is Astra. Astra is one I called out on my channel a lot, and a lot of people take it the wrong way and think I don't believe in Astra, what Astra is doing. I am skeptical of some of their stuff, but my real problem is them trading at a $2.37 billion valuation with a sketchy line of revenue. Another company that I call out, STEM Inc., has had started off as a SPAC with zero revenue, but they have been producing on their revenue throughout the recent quarters, which makes their multi-billion dollar valuation very realistic. The problem with what Astra is doing is they based all their revenue off rocket launches that they've yet to succeed on. Therefore, their revenue can easily get pushed back a couple years, and this $2.37 billion valuation I could easily see become a $600 million to low $500 million valuation. My problem with Astra isn't what they're trying to do, it's that the valuation is very high for a company that could very easily keep pushing off revenue. I like it when my companies have an easy source of revenue coming in, or one that's going to be easily accounted for in the future. And I'm going to show you a company that's doing something very similar to Astra that I'm not buying now, but I'm going to put on my watch list and slowly wait to see when conditions get better. I would be interested in picking up Astra stock, but not until I start seeing some successful launches and some revenue coming in. I think until then, it's kind of a waste of time to be holding, because I don't see this company really skyrocketing to the tens of billion dollars of valuation until they really start bringing some revenue on their contracts. So therefore, I do not hate what Astra is doing. I want to see success and I want to see some revenue before I get in. And you guys have to understand, investing in these low market cap companies, SPACs, is already very risky. A lot of investors won't get into a company before they start making profit. All I'm asking is to see some revenue with a good product. Without revenue, it's really hard for me to gauge the market, and something that I think is necessary. And like I said, guys, I'm going to go to some good SPACs I like later in this video, and I want you guys to notice the quality upgrade that I'm going to show you, so make sure you stick around for that. I'm not going to cover this one very long, but the last one is Nikola, and this is an example of a stock that I really don't like at all for their technology, and it's trading at a $4 billion valuation with no sales. For those of you who don't know, and most of you probably do, Nikola is almost more of a marketing campaign with a whole bunch of ideas rather than any actual realistic technology. But these are the things you have to realize that are problems with companies making no revenue. A lot of these SPACs really weren't heavily regulated by the SEC, and therefore there could be more scams than you guys would think. No one thought Nikola was a scam until their CEO started getting sued by the SEC. I'm not saying that's the case with Lucid or Astra at all. I just want you guys to make sure that without seeing revenue, it's very hard to take someone's word on what a company is. Now I want to get into a SPAC I actually love, and I'm actually going to be buying heavily once it de-SPACs. And that is Concord Acquisition Company, and they were buying the company Circle. If you don't know about Circle, make sure you check my video out on it, because I think this could be an absolute behemoth in the fintech and crypto industry. It's a great crossover that's going to be heavily regulated, but essential for the crypto markets. Essentially what they have is their own collateralized stablecoin that's essentially the biggest stablecoin leading the market right now, and Circle's looking to become a federally chartered bank to become essentially the first digital bank in the United States. One of the reasons I love Circle so much is because they have an open source platform that anyone can plug into. That's what the Circle token is built on their blockchain. It's really the USDC token, but it's built on an open source blockchain that anyone can plug into. This makes it very easy for a whole bunch of people or a whole bunch of companies, rather than having to integrate payment systems with each other, just integrating into the USDC blockchain and then being hooked up to one another and being able to have a neutral payment ground for payments. I know, make sure you check out my Circle video, because I don't want to go too in depth in it here, but I really do think Circle has a extremely important and necessary business model in the future global financial system, and it's also very appropriately valued compared to other SPACs we see. So Circle actually in 2020 had $50 million of revenue, and now in 2021 are looking at $115 million. This is more than 100% revenue growth year over year, and the company is only being valued at about $4.5 billion right now pre-SPAC merger. So that's comparing something to Lucid that's trading at a $32 billion valuation and only making $100,000 in revenue, versus someone like Circle with a $4.5 billion valuation and making $115 million in revenue. Not only that, but Circle's really going to be mostly a software company and really going to make very high margins and need a very low employee headcount. That's going to make their essentially business very scalable, very quick, unlike someone like Lucid, who has to mass manufacture cars and who even knows how good the software on their self-driving side is. That's really giving Tesla their lofty valuations. I really like investing in something like Circle because they're growing so quickly. They have great revenue growth. I think they have a very... before I say that, Their USDC stablecoin already has a market capitalization of $28 billion. And this is all money that Circle is going to collateralize on their balance sheet. So that's amazing, because you're getting a company Circle for a or $4.5 billion valuation, but they have $28 billion worth of assets. And even if these assets don't translate one-to-one, it's still amazing, because rather than a company like Lucid, and I hate to keep picking on Lucid, it's just an easy example, that's losing over $1 billion a quarter, Circle actually has $28 billion of assets that they can utilize. Maybe not exactly how they want to, but they still can use it to a benefit. This is one of the reasons I love Circle, and I just think is a great example of picking high quality SPACs. I built a position in Concord back here around $10, and it's about a half a position, but I'd be willing to really make this position pretty big. I'm waiting for it to go de-SPAC just so I can see how the stock reacts, but I'm really going to keep adding because I really love this company. Last of all, I wanted to get into one SPAC that's not making revenue yet, but one that I'm ready to sit on and see how it does, and that's BlackSky. For those of you who don't know, BlackSky is essentially trying to create a global satellite network for real-time surveillance, and recently partnered with Palantir, and Palantir actually invested in them. BlackSky is actually a SPAC that I bought around here at $10. We saw a pump up on their listing, and I sold out of most of my position, not because I was trying to make a quick buck, just because I really understood that they had no revenue, and it was probably going to take a while before that revenue became flowing in. It was taking them a while to get all their rockets in the air, and I was just ready to sit and watch how this company did. One thing that I was worried about was something like a Markforged happening, where they de-SPAC'd and kind of slowly went down and really decreased in value because of the overall SPAC sell-off. Markforged is another one I'd be happy to add to, but I really want to see a basing structure and a comfortable bottom before I really start getting aggressive. I love Markforged as the company. It's just a hard time to be buying SPACs aggressively, and I really think the most important video, or the most important lesson of this video, is really just to calm down when you're buying these companies and buy over a longer span of time. I know when you see a highly volatile market and stuff like this happening, it seems like one pump and you missed out on it. But honestly, the trend right now is that a lot of these SPACs are coming back, and it really is better to take your time and slowly build positions out. It's also very important to understand where this company is, because every SPAC is completely different. I am buying Concord much more aggressively than I am Markforged or BlackSky, or I'm buying Concord and the most aggressively because of their massive revenue growth. Markforged slowly because they're only doing $20 million in revenue growth, but it's a company I like. And BlackSky I'm just waiting on because they don't have any revenue growth, and I'm willing to wait a year if it means that I can see them getting their product in the air and good adoption. If I was to build a massive position when this was going up, I would already kind of be down on my investment, and I wouldn't be prepared to see if this started bottoming. Overall, guys, I just wanted to give this update on the greater SPAC market. I think the more SPACs crash, the better deals we're all going to get. I just want to make it clear that I don't think you should really ever be going super heavy, especially on companies with no revenue. I think a lot of these companies will be monsters in the future. I just think we need to taper our expectations and buy them slowly, so that we can really get a good dollar cost average and not have overbuilt positions while these companies are still falling. Anyway, guys, I hope you liked this video, and I hope it helped a lot. I don't mean to bash on anyone's company. I'm just trying to show you guys that when you have these ridiculous valuations with no revenue, I just want to make it clear that there are companies in the SPAC market that you can feel more comfortable buying right now that you really don't have to sit on. For me, that's Circle. Anyway, guys, I hope you like this video. Make sure you like it down below and subscribe to the channel. I'm going to be trying to do videos like this almost every day. So comment down below what you want to see. And for now, Mikkel out.